Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. There are now 18 Dividend Hero investment companies with at least 20 years of consecutive annual dividend increases. Of these, an exceptional 8 investment companies have increased their dividends for 50 or more consecutive years, a remarkable achievement. These dividend heroes are no strangers to difficult times, having raised their payouts to investors through the high inflation of the 1970s, recession of the 1990s, and the global financial crisis in 2008. Today, I'm delighted to be joined by 3 Dividend Hero investment company managers whose companies have increased their dividends for more than 50 consecutive years. I've got here William Meaden, manager of JPMorgan Claverhouse Investment Trust, Jabe Curtis, manager of City of London Investment Trust, and Craig Baker, manager of Alliance Trust. Right, on to the questions. Jabe, how have you achieved so many years of dividend growth?
Well, we have a portfolio with a core of consistent companies which have been able to grow the dividends consistently, but undoubtedly the investment trust structure has been crucial as well in difficult years for dividends across the market, such as you had at the start of the pandemic when there were widespread dividend cuts. We've been able to dip into our revenue reserves to keep our dividend growth going. We had to do that for 2 years in 2020 and 2021 before recovery of dividends occurred, and we were able to cover our dividend again. So revenue reserves are a key advantage that investment trusts have.
Absolutely, in very tough times through the pandemic. Craig, how have you increased your dividends over this time period?
Yeah, well, I think the key is that we've got a very long-term approach and we have a multi-manager approach, but each of our stock pickers are thinking about finding companies with a competitive advantage or intellectual property advantage that means that they've got a moat. Essentially, they can produce strong free cash flow, and that free cash flow will grow over time. And so through a long-term approach, we feel very confident that we can get companies that are throwing off rising dividends over time. And again, with the investment trust structure, we're able to make sure that even in those years where it hasn't increased on the underlying companies, the dividend income, we can still pay out a positive increase in dividends from Alliance Trust itself. So those together, I think, are the key as to how we've been able to do it.
Thanks very much. And William, how have you achieved so many years of dividend growth?
Well, Claverhouse has always invested in a diversified portfolio, some 60 to 80 stocks invested solely in the UK market. At the moment, it's predominantly invested in the FTSE 100 stocks, and those stocks tend to be very good in terms of cash generation, very strong balance sheets, and consequently very good dividend payers. And so in good times, the portfolio generates its own income. And like the other investment trust managers, we call upon in more difficult times the reserves that we've tucked away to smooth that dividend income for our shareholders.
Thank you so much. I just want to clarify, investment trusts have a very good structure for income investing. They can retain up to 15% of the dividends they receive from their investee companies every year, and they retain those in their revenue reserves. And when times get tough, and unfortunately, as we all know, if we're investors, times always get tough, then they can use those reserves to boost their dividends. And that's why they've got such a long track record of dividend increases. So William, which sectors and regions are you looking at the moment to invest in to increase your dividend going forward?
Well, the outlook for dividends in the UK at the moment is looking quite good, I think, Annabel. There are many sectors where we can see dividend increases of certainly high single-digit percentages. But I would particularly call out the banks at the moment and looking very attractive. They've spent the last 12 years sort of rebuilding their balance sheets from the consequences of the financial crisis in 2008. So, for example, if you take NatWest, it now has very strong Tier 1 capital, some 14 or 15%, compared to just 4% a few years ago. Its recent figures were very good, as were all the other banks, and they're not only doing dividend increases, they're buying back shares as well. The fines of mis-selling in PPI seem to be well behind us, and also we have now an environment where interest rates are going up, and that tends to be very good for bank profits. So that confluence of those 3 events, I think, gives me great confidence about the outlook for bank dividends.
Absolutely, interest rates going up. I can see my mortgages going up. Yeah, definitely good news for banks. Joe, which regions, which sectors are you finding opportunities at the moment?
Yes, I'd agree with a lot what William said about the UK and also about the banks. But in addition, as I said, we find the consumer staples companies, which are often very global and sort of make and sell the everyday products. They're kind of well placed in what is probably a more difficult economic environment. And I think it's probably also worth adding, it's worth perhaps being cautious on some of the more cyclical companies out there, like in the discrete consumer discretionary sectors, which might be hit harder by the cost of living crisis, and also indebted companies where dividends are likely to be more vulnerable.
Absolutely, I think we all know about that with this cost of living crisis at the moment. Craig, what regions or what sectors are you finding attractive at the moment from an income perspective?
Yeah, actually some similar themes to what the previous two have talked about, but actually ours is a global trust, and so finding some of those ideas around the world. So within financials, actually some interesting things in the emerging markets that are paying reasonable dividends. Some of the insurance sector in the US, UK, and actually having been underweight energy for a number of years, actually overweight through last year, and that was an area that produced good dividend payments for us. UK companies, Brazilian companies, US companies in that space as well.
Right, yes. Obviously very interesting. You've got that global portfolio to actually look for income opportunities. Joe, back to the UK. Why is it a good place for income opportunities at the moment? What value is the UK offering?
Well, I think the UK is looking cheap at the moment on a number of valuation measures, and I mean, it has underperformed some of the world markets until last year when it did a lot better, in actual fact. But I think the UK is cheap, and I think the evidence of this is the number of takeover bids we've seen across the UK market recently, and indeed some companies are moving to overseas markets because they can get a better rating. So I think there's an advantage for being invested in the UK to when our market's so cheap, and I believe in the end value will come out, and there's a good chance over time of the market being re-rated upwards.
Let's hope so. William, why do you think the UK is a good opportunity for income investors right now?
Well, the UK has been completely neglected by global investors the last 10 years, and consequently it sits on really knockdown valuations, some 40% discount, for example, to the US market, on PE ratios, on dividend yield ratios. And at a time when value is coming back into fashion again, having had a long period of out of fashion against growth, the UK is the ultimate value market, I would say. So if one wants to buy value, I would encourage investors to at least not put all their eggs in the UK basket, but at least start to increase the proportion of their funds that are invested in the UK, because the investment skies are not particularly clear at the moment, but at least while you're waiting for those investment skies to clear, you're being paid a very handsome dividend yield along the way. And in an investment trust structure, you will be getting that dividend growth as well, hopefully.
Absolutely, and 40% discount to the US market, that's quite a discount.
It's a generational low. It really is as low as it has been for some 40 years.
Right, well, let's hope it moves on from there. Craig, what's the appeal of global equities for income seekers?
Yeah, well, I think I'll probably bring out a few things in that. The first one and most obvious, I think, for a bottom-up stock-picking trust like ours, is that by going global rather than just UK, you're actually multiplying your opportunity set by a factor of 10. And so there's always going to be the opportunity to find great companies that are producing positive free cash flow that's growing and allows them to pay a rising dividend over time. So that's the first thing. The second thing I'd bring out is that while historically the UK has stood out really as being the major market around the world that has had the highest dividend yield, that's changing, and you're seeing other markets increasing their average dividend yield. And so there's definitely companies within each of those that can be found that are high dividend payers, certainly high dividend growers over the long term. And then the third point I'd just make is that there's just this advantage that you're not wedded to one industry structure of one country. And so if we take the UK, it does have some biases in it. It tends to have companies listed there that are big in the financial sector, energy sector, utilities, tobacco sectors, hence why it tends to have high dividend paying companies. But there's a good question as to, over the very long term, notwithstanding some of the short-term advantages of the valuations in the UK, whether these are companies that are going to have as many growth prospects as some of the other markets that have got more growth-oriented sectors in them, and whether they've actually got more sustainability issues attached to some of those sectors than others.
I can see there's a very good case for having obviously some global allocation if you're an income investor, as well as some UK allocation. Coming back to you, Craig, what does equity income investing look like in a world of higher interest rates, which we have now?
Yeah, so in a period of high interest rates and rates staying high, income investing starts to look particularly attractive. I mean, just mathematically, your current income that you're receiving from dividends becomes more valuable relative to the dividends you might get in the future through rising dividends at a later date. And so that happens with high interest rates, and that's certainly been why income investing has been in vogue recently. It also throws up the point that in a high inflation, high interest rate environment, you're likely to see more volatility in markets, given that central banks are walking this tightrope between curbing inflation and not hitting growth too much. And so being invested in companies that are able to withstand any recessionary environment, and those are typically ones with high free cash flow, and those again are correlated with ones that can pay out high dividends over time.
Yeah, I do think in these uncertain times, it's very reassuring for investors to see those dividends coming in and increasing over time. Joe, high interest rates world, what does equity income investing look like?
I'd first say I wouldn't call it actually a high interest rate world. It is high relative to the period since the financial crisis, for sure, but I would say that's a period with ultra low interest rate, in fact the lowest in the whole history of the Bank of England going back to the 18th century. If you go back to the period before 2007, the level of interest rates we got at the moment is similar. Really, it wouldn't have been out of place in that era at all. But I think the great advantage of equities is the dividend growth. And I think a particular period where there is some inflation around, if you're in fixed interest, you're by definition it's fixed. It doesn't go up, the income. So I think the advantage of equities in this period, is where people are facing rising bills. Is that you want to be in a vehicle where you get rising dividends.
Absolutely. We show the 5-year dividend growth figure as a percentage per year on our website, so investors can take a look at that, as well as all your dividend history. Quite honestly, we've got yours going back to, I think, to the 70s. That's as much as we can fit on the page. William, in a higher interest rate environment, what do you think equity income investing is going to look like?
Well, I think the higher interest rates that we've got now are just one feature of the new investment world that we find ourselves in post the invasion of Ukraine some 12 months ago. That really was a turning point, both for the real world and for the investment world. And I think several things follow from that. I think investors are going to have to learn to live with higher levels of inflation, as a consequence, higher interest rates. But I think other things follow. I think the era of get rich quick, which arguably we had when money was cheap and plentiful the last 10 years, is well and truly over. If you look at the money that's been lost in the NASDAQ in the last 12 months, the S&P index, cryptocurrency, my goodness me, 40, 50% down if indeed you're in something that hasn't been suspended. And I think investors are going to have to recalibrate their expectations of the sort of returns they can expect. I think they should start to focus more on the risk that they're taking when they're in certain investments as much as the potential reward. And I think the old-fashioned virtues of compound investing, patience, buying value stocks and tucking them away for a long period of time will all come back into fashion. And that, I think, leads you to the UK market, solid blue chip shares, good corporate governance, good dividend paying. And these are global companies. The UK stock market is not the UK economy. 70% of revenues of FTSE 100 stocks comes from overseas. And so you're buying, when you buy the FTSE 100, which is where Claverhouse is predominantly invested, you're buying global on the cheap. And while you wait for the investment skies to clear, you're being paid a very good, consistent dividend, particularly in an investment trust structure, along the way. And that seems pretty compelling in this environment to me.
Yeah, well, I think you're right. I think the world has changed. And obviously, I mean, we've got a lot of interest from private investors in these sort of equity income investment companies. But I think they will be even more reassured in these uncertain times that at least they are going to see those dividends and they're investing in big sort of blue chip companies. I'd like to thank you all very much for joining us today. It's been great to hear our managers talk about their strong dividend track records and how they achieve them. But I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. So if you're in any doubt, you should talk to a financial advisor. Thank you so much for watching.